Yeah, I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it, fuse like a magnet. Lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Rising the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same, cause that's what it takes.
All right, guys, welcome. Tony Denaro here. I have two guests with me today, May and Sparky. Welcome, guys. Thank you for taking some of your free time.
Thanks.
So the plan is for the audience, just to give you guys a heads up, I have a slide deck here, which I'm going to put up just to kind of give us a rough outline of what the information is that we want to talk about. But first, I want to do some introductions. Obviously, you guys know me. I'm Tony. I am not a bond holder. I'm not a bond trader. I'm barely a bond. I'm not even a bond expert, which is why I have Sparky and May here. They know much more about this than I do. But as a equity investor, the common stock, I am looking at this debt restructuring as one of the key things that I need to keep my eye on as it pertains to my stock investment in AMC. And so there were things as I've been digging into this over the last few weeks or a month or so that I realized I had bad assumptions or, just general things that I had incorrect. And I like to take the opportunity when I'm learning stuff to share that with you guys. And then also tonight, give you a chance to ask these two folks who know much more about it than me, how the bonds play into AMC's debt and the debt restructuring. So May, why don't you introduce yourself real quick and tell us about just a high level, and then we'll let Sparky go and then get into the material.
Okay, thanks again for inviting me. I always love being a guest on the show. I'm Markets with May. You can find me on Twitter, or X, I guess it's now called, at Markets with May. And I also have a blog that you can, if you go to my link tree on any of my social, that you can find. So I just started that, so I'm very excited. By way of background, I've worked at a couple big investment banks, Goldman Sachs, Morgan Stanley. I was on the buy side for a while. And as far as debt specifically goes, without going into all of it, I did broker credit default swaps for a little while, and I've done risk management for some high yield distressed funds before. And so that's my background.
And
Sparky?
I'm coming from the other side of this. It's interesting because I've been on the buy side for about 5 years, running a just under $1 billion investment grade portfolio. But prior to that, I spent 30 years in a mid-market boutique firm that did high yield debt and distressed workouts and traded and underwrote municipal bonds, did a little bit of everything. So May's on the buy side more than I have. I enjoy being on the buy side.
So that's
the interesting thing is, having talked to Tony, I'm a bond guy. I really know very little about stocks, and part of that, and May might even be able to tell you, is for the whole time I was at this firm for 20 plus years, I generally wasn't allowed to own individual stocks, and May run into that too. There's so many restriction lists and research they're issuing and underwriting. I just did really did ETFs and stuff for decades. And it's only been the last couple of years that I'm getting into do individual stocks and credit from that standpoint. So it's been, Tony's helping me with options. One of these days I'll actually be long AMC because one of my $3 puts will actually fill and I'll be long this thing. But so far I'm just collecting premium.
But nobody on this panel is short AMC. Am I correct?
No, and I'm not long or short bonds or anything else.
I get the impression as I'm looking around on social media that when we have anyone mentions the word bond, and I see this in May's feed a lot. If you mention the word bond, people assume that you work for the dark side.
It's
And,
mean.
and
So mean.
maybe we can clear some of that up tonight, but we're going to be talking about bonds because that is the debt, a large portion of it that AMC needs to restructure. So it's an unavoidable topic, right? Am I incorrect? Anybody?
No, and the only thing I'll add to that, Tony, and I think I torqued you all this earlier, is that to me as a bond guy, there's two different things that get done, and AMC actually has done both of them in the last 4 years. There's restructuring, which is generally when you're going back to current holders and saying, hey, we'll go bankrupt if we try to support this or pay this off in the next couple of years. We want to cut down the amount of power you have. We'll make some kind of concessions, move the debt out. The second part is a refinancing, which they've also done. Now, a refinancing, if they can get to that point, generally works for everybody. It works for the bondholders. It certainly works for the equity holders. And not to take too much to start, but AMC in 2022, I'll start with that one first. We had a very active, very aggressive high yield market. So even in 2022, 2 years into COVID, AMC was able to take some 10.5% debt they had and some 15% PIKs they had and issue a new 7.5 or 7-year bond at 7.5%. And that was just purely from the appetite. AMC certainly wasn't making any money, and they were probably in worse financial shape than they are even now. But that was a refinancing. No existing bondholder lost a penny. They had a call option. The bonds were at close enough to par. I think the 15s were actually a little over par. The company was able to force redemption, which is important. They were able to force redemption of what was outstanding. They went out and marketed a new deal to basically pay for it. And that deal actually was upsized from $500 million to $950 million. That's the 7.5% bond you'll see on a slide here Tony put together. Because the appetite for it was so great, they took out two deals. But the important thing is nobody that was an existing holder lost a penny. On a restructuring, which they did in 2020, which was in the heart of COVID, that's where they took, I think, 4 or 5 different deals that were trading at huge discounts, 40 cents on the dollar, 30 cents on the dollar. And they went to those bondholders and said, we're going to tender for your bonds at 50 cents. They were only trading at 40, so there's some incentive for them to turn them in. And we'll give you a 10% bond coupon to kind of make up cash flows for the 5 to 7% ones you're giving up. And they got an 80+% response to that tender. That's a restructuring because that's where the bondholders actually had to give something up. They had to give up half of their basically future par value. And the reason they did it is if they didn't, the company would have gone bankrupt. And the Tony's going to show the pieces of some of those 40, 50 million or 100 million of some of those deals that are still outstanding. If the pair off to not doing the tenders, if enough people didn't do it, they would have just called it off and the company probably would have declared bankruptcy. But they got enough people to do it. And then in addition, it looks like they issued about 200, maybe 250 million of cash. I was trying to figure out how. I know one discussion I always have with Tony is I think any part of refinance or restructuring will probably involve a cash raise or an equity raise, selling shares to give the bond some protection. I don't think they had to shelf to do this in 2020, which was part of their problem and why they were in trouble. So they did this exchange, were able to raise, the 250 million they probably thought they needed for 6 or 8 months until they could get the ability to sell some shares. So that's how they survived 2020. So anyway, that's not to pick on you, Tony, but that's as a bond geek, that's my distinction.
I spent the better part of today going back all the way to 2015 to try and recreate the timeline of all the debt they had and how the AMC's been restructuring debt since almost day one in 2015. It's very complex for a newbie, a novice in bond trading, or a novice in debt to go try and untangle everything that's happened over the last 10 years.
In the difference with high yield, which AMC's been high yield as long as I've,
Yeah.
you have to go back, and May probably knows this too. The difference with high yield is, unlike a regular bond or the loan we're going to talk about, they have that don't generally have calls. When you normally issue a corporate bond, it doesn't have a call. It may have a make whole call or something, but that's not economically feasible for anything. But high yield debt generally will have, if it's a 7-year bond, maybe it has it's what you're seeing. It'll have a 4-year call that's at $105 price, maybe a 5-year call at $103, and it declines to par maybe 2 years before it's due. And the reason they have those in there is so they can do restructurings. And it benefits the company, because if they're doing better and they have better cash flows, it lets them take that debt out again without having to negotiate with creditors. If they have a call and it's at par or whatever, and it's in the money and it's economically worth it for them, it's their option to go take that out and then go issue a new debt, bond like they did in 22 at a much lower rate. So high yield bonds generally have those calls in them, and it's not unusual. You're looking at all this activity. If you looked at a better rated high yield bond, like a Schmuckers or something, that was a deal we did at my other firm. That's a double B rated bond. Well, they have a lot more options. So they might issue 10-year debt with 5-year calls, and they're constantly shuffling that around. If rates are to their advantage or they want to put it in a different maturity, that's a little distinct different with high yield versus regular bond debt, which generally, when Apple issues bonds and we buy them, they issue a 5-year bond and we go out and buy it because we want the money to come due in 5 years, and it's not callable, and they don't have any intention of calling them. There's no economic reason for them to call them. So I didn't mean to jump in everybody. That's my.
Maybe, did you want to, have any comments on what he just said before we dive into what is the actual debt that we're talking about here for AMC right now?
This a little bit of just an addition to the history in case it's gotten kind of it's probably irrelevant for the future, but it might just help to help anyone that's trying to understand the nature of the timeline. It wasn't until the vote post the AMC reverse converge that you got rid of the issue as relates to the article in the articles that disallowed additional equity issuance.
Mm-hmm.
So that's kind of just in case that actually ends up being relevant as we're talking about the timeline and why certain debt looks the way it looks. I thought I'd just throw that out there.
But that was the biggest challenge AMC had.
Totally.
As much as people and as convoluted as APE was, I actually think it's half brilliant and half evil. But that's, if they didn't do it, they wouldn't have survived.
Yeah.
I had never seen a structure like that. They obviously got the right lawyers, because it's been challenged, as recently as, the last day or two. I think you put out that the higher court, passed.
The Supreme Court opinion came in this morning, as a matter of fact.
Yeah. So that passed on what they did. So they had good lawyers doing this, but they just didn't have a choice. For all the people that complain about it, they didn't have the right to sell shares. Now they do. So it changes the stuff we're going to talk about, goes hand in hand with the ability to raise capital, either swapping shares or selling them.
So the reason, all right, the debt, why do they need to restructure? There is debt coming due. You can see I have it highlighted here in green and yellow. In 2026, we got 1.9 billion on a term loan. We got 951 million, which they just paid off some of that. So it's 787 million, 787 of the PIK toggle. And then we have 51 million on a 5.8% note. Why do they need to pay this off? I'm just going to give you the novice way of saying it, and then May and Sparky can add in some color to what I'm going to say. But right now, if you look in AMC's quarterly filings, and we heard Adam Aaron say there's no, what did he say? Bankruptcy is inconceivable.
Yeah.
Right.
Well, I mean, that is true for the moment. And in the filings, there is no ongoing concern risk factor. So that means that accountants and the auditors have looked at the books for the next 12 months and the expected cash flows, and the company should be able to service its debt and pay its bills for the next 12 months. However, in June of 2026, which is 2 years away, this debt, everything you see here that's highlighted, is going to need to be, it's going to come due. So they have to deal with it. And the company is just frankly not going to throw off enough positive cash flow or enough profits to cover, what is that, $2.9 billion?
Yeah, it's 2.9. And
we're just not. I mean, even if we were wildly successful, we're not going to profit 2.9 billion extra dollars in 2 years. So at some point, mid 2026, these numbers that are highlighted do become a bankruptcy risk problem, because if they default, if they can't pay it back when it's due, then now you have the debt holders that could force a bankruptcy or force some sort of court-ordered restructuring.
Yeah,
so
which at that point,
Mayor Sparky, jump in and clarify anything I got
I'll let
incorrect.
you ladies first. I'll let you go first, and then I'll.
I mean, I'm not as worried about the one in green. I don't know, Sparky, do you agree?
All right, then I'll jump in. My conversation I've had with Tony is, I think the company's doing the absolute right thing, attacking that second lien debt. That's the 10.
Yeah.
That's
because
this one right here.
Right, because yes, it is down to 800 million. I give them credit. It was 1.6 billion, so they knocked quite a bit off of that. But just like we were talking about, this is kind of a finer consideration. But as easy as they were able to do the refinance in 22, the reason they were able to do that is that was a first lien, top of the credit scale bond. When you're a debt holder, that's the one you want. The 10% is a second lien subordinated. That one's going to be, at least in the current market, it's going to be almost impossible to refinance. So, it trades at 80 cents on the dollar. It's been as low as 50 cents in the last 12 months. So they are doing what they have to do to take that out, whether it's stock or however. And even if they don't get it all out, let's say they get it down to 100 or 200 million by 25, that's a much more manageable amount to then have to go to the market and finance. And I agree with you, May, that whether it's 2 billion or 1.9 billion, the credit profile of that bond gets better as they take out the subordinated bond. Because more of the cash flow goes to that senior first lien, it gets more protection. And it might actually, you and I talked about this, Tony, you asked me the question of what might give them an upgrade. I mean, they're not going to get upgraded to investment grade, but if they, through a combination of cash flows, hopefully the second half of this year into 25, and maybe using, the stock goes up, they use more stock to take that 780 million or whatever left is out, it wouldn't surprise me that their senior first lien bonds, might get upgraded a notch. They might get upgraded to single B, which doesn't sound like a lot, but you all of a sudden make it much more refinanceable in 26. And in May, it sounds like you would agree with me, if they don't have to, especially since it's a loan, they can't call it anyway. If they're in better position and don't have more debt and they've reduced it, I don't think they'll have any problem refinancing that, paying it off. In other words, doing a new deal to pay it off. And you don't know what the terms are now. That's 2 years from now, but it almost doesn't matter. They will be able to go out and borrow money and roll that, assuming
you're talking about rolling the term loan.
I'm talking about the loan. Yeah, that's the big one. And that's when May highlighted is she doesn't think it's a problem, and she's right, assuming the company continues to improve and can pay down. I mean, there's a couple other things that have to happen, but because it's the most senior bond they have, at least in the AMC stack, it would be it's the one that's most likely to find buyers, especially if they pay off the sub bond and it gets an upgrade at all. I mean, even to a single B, that opens up more people that can buy it. There probably are funds that won't buy triple C's. Now you get into the B range and you open up more participants. And
so let's talk about the 51 million, 5.875%. That I think we all agree that They're just going to let that go to term, right?
Yeah, they'll just pay that. And that's it. In one thing I had mentioned to you, I think, Tony, is that being a subordinated debt like the 10% it was put into, that generally can't be rolled into refinancing the senior 26s anyway. So what they could do is when they roll the 26s, the senior loan, if they get a lot of interest for it, and again, this is a year and a half from now, they very likely might be able to make that a $2.2 million deal instead of so they'll pay off the 1.9 and raise 100 or 200 million, whatever they need to pay off these little sub pieces.
Yeah,
They'll do it with cash. They're not going to do another sub deal, I don't think.
Go ahead, May.
One little thing I just wanted to mention. So we probably, because we're shortcutting the way that we're saying it, just for the folks that are listening, the PIK toggles are they're 12%. They're at the moment. And I really just want to mention that because I actually think the 12 3/4 Odeon senior notes, because the covenants disallow any kind of buybacks and also they're quite restrictive. Those are the two bonds that if you read the things that I post on Twitter that I would love to see gone. If they were going to do another capital raise, even with the 1.9 due, because of the things that Sparky has very clearly indicated, which I 100% agree with, really, if you made progress on the 12 3/4 next, that would be freaking amazing because it would really it would just be a better position from which to roll the senior secured credit facility, in my opinion.
So maybe that's the second line here, the 12.75% Odeon, which are higher credit rating than the other.
Yeah, they're operating company. That's why.
Yeah.
But it would be, what you're saying, May, is it would be a nice to have, even though that's not due to 2027, if they could structure a deal to knock out the date on that one, push it with the 10-12 PIK toggle.
Well, the Odeon has covenants that disallow. I'm pretty sure I remember reading that, and that it's the Odeons that also have covenants that disallow.
And that's why they haven't taken any out so far. I think it is a fairly covenant-heavy deal, and there's also something a little different with that. I think that it's not a euro dollar, but I think that might be an issue. That was like the British Odeon they bought, or something.
It was. Right.
I think there's something. This is really getting in the weeds, but I remember first looking at it, there might be something that's covered in British law that's much more restrictive than us. So I don't.
It might not be.
That might be the next one they attack, but I don't think they can just call them. And I don't know that they want to start using stock swaps against buying them in the open market. You say there's probably, I think there's a line of delineation that. They could do it, but there's some accounting reason or some reason.
That'll be the next thing I read up on. How about that?
And I tried to look at that because I thought the exact same thing May did. I'm like, well, if they took out the 15% PIK US, AMCs, they had toggles, they had, and they're taking out the 10% toggle, second liens. Why have they not attacked that? And I have a feeling because it's. And I'm not a lawyer, I'm not a CPA, I'm not anything. I'm just a bond geek. But I think there might be language or, there's obviously tougher covenants, but it also might be based on it being like they purchased a British company, not a U.S. company. So I think there might be other considerations that we aren't.
The only thing I was thinking on that one was just because, it is actually secured with assets. So
and it's a higher rated. It's already single B rated. So it's a higher rated bond.
So it would be really easy to refi that, as far as
at some point they could. Yeah.
So it might be that's how they'll take it out, is they'll just basically, when they do the 1L senior, they might just do exactly what you were mentioning earlier.
And there might be some limitation of time. And again, I don't.
Yeah.
There might be language in there, and I haven't looked through the prospectus of that deal, but maybe at some point in the next 3 years, they lose whatever restriction they have under whatever rules are made.
That happens.
And then you'll see an Odeon deal almost immediately for whatever level they get for doing senior secured Odeon, and you'll see that get taken out. Nobody seems to be worried about that one. I think that's the best way
I
to
know.
put it. Tell me otherwise, but they seem to be really focused on the 10s and even not particularly focused on the other subs. I think just because they're small enough.
But the rate's so great on those. You wouldn't refi those.
That's the other reason you wouldn't take them out. Is they're like some of them are 5 to 6 and 7.
Yeah, let it go, let it ride. You know,
but also it's nice and spread out. You know, I mean, I think they have one coming due this year. They had Tony, you even mentioned. I think last year they had 40 million or something. They just paid cash for it. There's a 26 and a 27. It's only like 100 million, and I hate to say only, but that's really not a lot
compared to what we have on the debt list here. It's not a lot, right?
Yeah, I mean, but it's a good use of capital to not take them out. Exactly what you're saying. The rate's so low on them.
Yeah,
they don't want to take those out. You know, you don't pay off your 5.5% loan when you got 10% loans. You're buying at 85 cents on the dollar.
That'd be like paying off your 2% mortgage right now. Don't do it. You know what I mean?
So if I could summarize like the last 10 minutes conversation, I think I heard you both agree that the green highlighted, the term loan, that one is less of a priority for AMC because they can more easily roll it, assuming that they're able to attack the one that I have highlighted in yellow, the 783 million, the pick toggle. And maybe we have a nice to have would be to address the Odeon.
Get the Odeon.
If they
cash, even if they covered it with cash, it would put them in a beautiful position. So I don't need them to necessarily pay the Odeon, even though I'd love to stop paying the 12 3/4, quite frankly. Yeah. But like, if the because right now the cash position matches the debt, matches the 2Ls.
And so the other thing, just not to drag this out, we'll move on to the other thing, but that loan is it's not LIBOR, but it's an overnight, I think it's SOFR or something base loan plus 320. It's plus 300 plus then some 20 basis point fee or something. It's 8.5% now, but if rates are going to drop, which I'm not sure they'll do this year, but certainly over the next 18 months, it looks like the front end will come down.
I saw in previous years it was as low as like 3.8%.
Well, no, but that's the point. Is right? I certainly don't think the Fed's going to tighten anymore, even if they don't drop it. So along the lines with the other subs, that's, I shouldn't say only an 8.5% yield, but that's still less than the 10s and some of the other things. And they're trading in the low 90s again because they're first lien. That's not a real good candidate to take out. I saw they bought like 100 million of them because it was 2 billion and now it's 1.9. Maybe they did that at a time when they were cheap, or they maybe bought them just to support the price of them. I mean, there's nothing wrong with doing that either.
May, does this sound about right? Around $83 for the current price of the 2026 bonds these are publicly tradable, right?
Wait,
yeah, and I can look up the prices on Trace. So that is where they traded today.
They traded 86. I gotta yell at Morgan Stanley then.
No, they were. I saw a print at 83. They've been between 83 and 87, I think.
Yeah, I think they came back. I think they came back down.
Wait, are you talking about the 2Ls, or are you talking about the other?
The 2L.
Yeah, the 2Ls. I don't know. I don't have access to it, but I'm just
have a price. Remember,
I don't get all prices anymore.
Tony, I sent this to you on one of the. I don't think you put it in the slide, but at least on the list of AMC holdings that I sent you, they have a price of 83.83. So there was at least one size trade at $83+ price today.
And let Sparky or May, whoever wants to take this one, I just want to get some terminology out of the way. When we say a bond is callable, that means that the company has the option to pay it off early. They call the bond in. This particular debt, the 787 million, is callable at 106, but it's currently trading at just over 83.
Right.
Yeah.
So maybe May, if you want to take this third bullet point, and if not, Sparky can get it. Why? We have been talking a lot about this over the last couple of weeks. Why is it advantageous to AMC to fix the balance sheet or fix the income statement such that the bond prices increase closer to par, which is $100? Why is that advantageous to AMC to improve the trading price of the bonds to get this debt restructuring done?
Oh, I mean, it kind of depends on how you think about it, because in fairness, what you really need, like, there's not really a straightforward answer to this, because what you really need is for them to have less leverage. But in general, the first next immediate step is you need to get rid of both the ODN and the 2L so that you can actually have flexibility to start either issuing a dividend or buying back stock. And it's not between the two. It should be buyback. It should not be a dividend issuance, because this company needs capital. It should not be like using its capital stupidly in that regard until you are well past a couple of years of stable earnings and stable cash flow. This is not like an overnight situation that you'd be thinking about it. So hopefully, I'm not sure if you're looking for an answer for the MOAS folks who are always really
No, I think, Sparky over the past couple of weeks has expressed some concern to me that the bonds were trading so low that it's actually disadvantageous to AMC in terms of thinking about a debt
refinance.
Refinance, yeah. That it would have to be a restructuring. I guess, May, if you don't mind if I jump in, the only thing as a bond guy that I think is more important is it's who holds the option. AMC in 25 has an option to call these bonds at par. That means they don't have to negotiate like in a restructure, negotiate with holders price or anything. If they improve their balance sheet and these bonds move up in price, even close to par, doesn't have to be par. Let's say it's 97 or 98. It'll be economically feasible for them to go in and take out the whole issue at once with a call, assuming they could go negotiate a new issue on the other side that's longer, which if their finances were better, they'd be able to do. And that again is the difference between a restructure where you're negotiating prices and trying to figure out how many bonds you're swapping for how many else. If you can call the bonds, the company that is, they have control of doing it. The holders can't do anything about it. Generally, they're going to be the buyers of whatever of the new bonds you put out, because if they like the credit, especially if it's improving, they're going to jump in. Again, that's what we saw when they did the 10.5s to the 7.5s. The credit profile improved, so they got a lot of those people to stay in, and they had control of the deal. When you're trying to negotiate discount bonds with a number of different lenders, even if there's lender groups, it's probably pretty laborious and not very efficient. But when the price is high enough, you can just call them because you have another deal, at least marketed and targeted that's going to work. Then it's clean. And
do you have any reaction to that, May?
Everything, totally agree. I think if we were to try to, because everybody likes timeline and thinking about order of how it would work. And he's, Sparky's totally right. Like, it's really annoying to try to do this, like, debt holder by debt holder. Now, that said, and very fun at the same time, if you are in the open market buying it back and the market decides that it wants to discount your bonds like crazy and people are willing to do a debt for equity swap to do it, it is the case that you're probably doing that debt for equity swap not at par. So I actually don't mind if the market keeps doing something really, really stupid for a short period of time, not for too long. For a short little period of time, it's not the worst thing that could happen.
And that's May. I 100% agree with you. And I know Tony and I have had this. If
I wasn't a sub holder, I wouldn't feel that way. If I actually owned the 2Ls, I'd be pissed. But like as a sub holder, because I intend to hold those to par, it's a totally different animal. Like, buy that. Everyone that's in front of me, buy their debt back cheaper than it should. I'm totally a fan of that.
But that's actually to AA's credit, and everybody just rails on him. The one thing I think they're doing absolutely right is, since the bonds aren't up close to par, and Tony, you and I talked about this. Why haven't they done a refinancing deal? Why is it, why has he talked about it, but nothing's happening? Well, in the meantime, until the credit, the leverage comes down and until the numbers allow them to call the bonds, they're using stock to buy bonds back in the 80s or sometimes lower than that. That's a great use of capital. They're taking stock that they're generating and they're getting well over a 20% return. If you think about it, for 18 months to take them out. Well, they'll do that as long as the price is low.
Yeah, it's a huge return. And also for folks that are still trying to map back on the balance sheet and the income statement, the cash flow statement, realize that this company had interest expense of almost 400 million last year. That's a huge number. So if you get some of that back, and really if you look at like how the debt lays out, you will actually, it's 4 billion in debt, the audience plus the plus because the rates are so high on the audience plus the 2Ls, that's almost 50% of your interest expense. That's a big number that we don't then have to sell tickets at the freaking theater to try to make a big deal. It's not kind of a deal. So,
well, if you think about even the last 800 million they have in the 10%, if they take those out, that's 80 million in savings a year right there. I mean, besides the fact you're buying them at a discount and that goes on this, on the profit statement as a gain, which, I mean, it does, it's non-cash gain, but it's still a gain. But that's why it's a good use of capital. And I would hope once they got up, and I'm pulling for AMC. I'm certainly not a troll, even though I'm not an owner, is what'll happen, hopefully, is they'll buy enough of that back that the price will get up close enough to par that it won't be economically make sense for them to buy back using stock. They'll be able to price another deal and just call them if they haven't taken them all out. That's the end goal, I would think.
All right. So is it a fair summary to say that like right now when the price is low, they're going into the open market to buy them, right? This is kind of let's talk about the 163 million that they just bought back, that 8K we got last week. Right. Can you, either one of you, if you, since you're not getting as many minutes to speak.
Yeah, I'm talking too much. If
you, I love people that are not like trolling me.
if you know the process, May, of how they go accumulate all these bonds, 163 million, to pay them back, like they just did, trading them for stock. You can talk to that, and if not, we'll let Sparky take a stab at it.
Wait, wasn't this one just that looked like they directly negotiated with the bondholder? Was that right, or did I read that wrong?
Well, what they did, I don't want to jump in.
No, go ahead. It's okay, because I wasn't paying attention this week. I had some things that were going on.
You have May. You're covering hundreds more stock per week than us. So
yeah,
no, go ahead.
what they generally will do is they will get a commitment from somebody like a Silver Lake or there's probably a dozen boutique firms that just do capital raises and or debt for equity swaps, this kind of thing. They'll go to them, and it's always on a best effort basis, and they'll say, hey, our stock is trading at 3. They know we have the shelf, it's not a thing. We'll give you a commitment to buy up to 100 or 150 million in bonds. And it probably starts at a lower number, 100 million in bonds at this ratio, a stock of 3. If you can buy the bonds at between 75 and 85 cents, they'll go out and accumulate those bonds. And then what'll happen is once they get to the number they contracted for, that's within, a collar of limit of prices where they know the finances work, then they'll go and actually figure out the price. That 8K you saw where it said they paid 717 or 734.
733.
It's always a best effort basis. They're not sticking them. They're showing AMC, here's where we bought your 100 million bonds. Our average price was here. Here's every trade we did, and they'll show it to them. I mean, there's no reason to lie about it. They'll show them, and you can find it on Trace anyway. This is what we did. Here's our average price. You exchange those to us for X number of shares based on where it is at that time, $3. They give them some kind of cushion because I think those shares might be restricted. They're not forever, but when they take them on an exchange like that, they may have 30 days or even 60 days that they have to hold them. I don't remember exactly what the rules are, at least some portion of it. So they have some risk, but then they'll go out and hedge them. They'll sell calls or buy puts or do something to at least hedge that risk. And the negotiation of doing this, they'll probably have 3, 4, 5% margin for the person they went and did that with. You know what I'm saying? And that's negotiated in, and they do this so a deal gets done. You couldn't go to Goldman Sachs and say, hey, we'll give you, go buy us 100 million bonds and we'll give you stock or whatever. No, they work on the price.
See, I see a lot out there, people saying things like, oh, well, the evil bond hedge master owned all these bonds and they were short AMC. So they needed AMC to give them a bunch of shares so they could cover their naked shorts.
Well,
and what you're explaining is a completely different process than what I'm hearing on social media.
Yeah, I don't know that the boutique firm that does this doesn't go turn around and sell them to somebody that's short, because that's up to them. When they buy the shares, they can do whatever they want with them. I'm not going to lie. They don't have to sell them to retail, but it's just purely a math thing. All they're looking at is what are the dollars we spent getting 100 million in bonds out. It's 84 million plus the interest is what we accumulated these bonds over. And it's not a day, it might even be over a week or 10 days or something.
This one they worked over the day, because that's the only way they got that price.
Well, no, but that's how they do it with the stock. But they may have accumulated bonds over the course of a couple days. They go to them and said, we reached your mandate level. We got to the 100 million. The stock price is X. It's this many shares, and then they file an 8K, say, okay, we just did this. We just exchanged 23 million shares for 163 million bonds, and the net result was 717 a share or whatever it is. That's how that all comes together. And like I said, I haven't done one of those in a while, so maybe they can do it over a course of a couple hundred days. But the actual math doesn't come out until the day they come to them and say, here's all the bonds we bought to fill your order, fill your commitment. Here's our average price. The current price of AMC stock is 305 or whatever it is. They figure out the math. We're going to give you 5% or 3 or whatever it is, and they exchange the shares for bonds, and it's done.
In my very simple caveman brain, when people ask me, do you think they gave them to the naked shorts? I'm like, I don't know, and I don't really care, because it is unavoidable that we have to fix the balance sheet. It is unavoidable that this stuff needs to be paid off, and there's not a whole lot of options. So what are you going to do?
And it doesn't really matter. They're going to turn around, because they're not in the business of being an AMC, whoever it is that, whether it's Silver Lake or somebody else, they're not in the business of being a 20 million share AMC holder. They did this just based on math, and they're going to go sell them to whoever will buy them, to be honest with you. And my guess is they have a strategy similar to the company, where they don't sell them all at once and dump them. They probably sell a little bit every day, and they hedge it the best they can. And the better they hedge it, the more money they make. If it goes against them a little bit, they make a little less money. And that's the risk they take doing this deal.
I want to get to Wired's question that I have on the screen, but first, Von Steuben asked one that I think we can.
Wait, hold on a second. Then if they did it and they ended up with the shares, they probably hedged it out before.
Yeah, no, they probably do it as they're going. You're right about. I'm making it way too simple, but they're probably hedging it as they. At the end of every day, or even twice a day, they're going to say, "Hey, we're up to this many."
Yeah, but it's
12 million bonds at this price. Okay, give us.
I'm talking about the equity side. It should just look like a two-sided unwind. It wouldn't be them specifically that's doing. Do you know what I mean?
Right. I'm making it way too simple. They might even check in every hour and say, this is how many shares at this price we're locking it at.
Yeah, because I'm just saying, like, if they did the exchange, if they exchanged the debt for the equity, they would have to be going into that short the equity long, because they would be delivering the bonds and taking in stock so that they netted out the position.
Yeah, and they might be.
Their short is higher. Their short is already, like, they would have had to have done it. I'm trying to think of how they would have done it, because it would have had to been done like first thing in the morning.
Right. And in May, you're 100% right. And you're explaining it better than I do. As they get this commitment filled during the day, my guess is whoever's doing the swap is probably selling shares. Yeah, technically they're shorting them, but they're shorting them knowing they're exchanging bonds later that day for shares. And so
Yeah, they're not going to leave their risk just unmitigated. They're going to have to hedge it.
This is a two-sided thing. They're buying bonds, and they probably go out and sell some stock. They're buying, and it wouldn't surprise me. There's no big secret here when somebody's doing this deal. They're probably disclosing to the company, okay, we sold 13.5 million bonds today, or we bought 13.5 million bonds at this price. We sold 1,180,000 shares at this average price. What price are we exchanging? How many shares are we exchanging with you? And then they work it out so it makes sense, and they probably do that even a couple times a day, not even at the end of the week. They're probably doing it constantly to evenly spread that. If they're going to sell shares, they're going to do it over as long a period as they can because it affects the price less.
Yeah,
my guess.
Yeah, I mean, I guess there's a little bit of a mini pause because sometimes there are things that we're probably thinking we're skipping some steps for the folks that are watching. So if the price was done at 7 and change, and you got to think like that means that in the exchange. So yeah, when they decided to do it, somebody had to short the stock because you're going to deliver bonds against stock. And if you're a fund, you're not going to want the stock at the end of it. You're going to want it netted out. So realizing that where they shorted it has to have been higher than the 7 and change.
Right. No, and you're 100% right. And but
I'm saying this because I know some folks are going to freak out and be like, they shorted our stock, but it's not a fair way to think of it because
I think they were selling it a little at a time, knowing they are shorting it, but they're shorting it knowing at the end of the day they're getting shares from the company. They're not getting them from you or I or some random thing. They're getting them from the company, so they know.
But you have to realize this is a very, very sensitive group of people, so
they're shorting it for their own risk mitigation, not to not to drive your price down. It's just so at the end of the transaction they don't lose money.
But they're doing it to accommodate the situation too. That's what people have to remember is they're not doing this to screw equity holders. They're doing it to get this, whatever mechanism. And I'm sure it's even more complicated than we're all talking about. During the course of the day, every day for 5-6 days when they're doing this, there's a constant tally with how many shares they need to deliver and what price they're buying bonds. And it's a continuous, there's probably a spreadsheet that's this big that's running constantly. So it's not nefarious. They're just trying to get a deal done.
Right.
Where the numbers work for everybody.
I want to make sure because for some of these folks that are more on the MOAS side, the timing of how the numbers would lay out probably is pretty important to those folks. Right. So we did actually see maybe Sparky has the volume numbers of the bonds that traded that day, but there was actually decent volume.
It was enormous. It was, and it's hard to tell what they bought versus what was just trading. Looking at Trace, and I think I even sent Tony this.
Yeah, the price on the bonds went from like 70 to 85 or 86.
But it was literally pages and pages of I just sort out million plus trades, which in AMC and the 10s, maybe there's a dozen trades a day in a normal day, 12 to 20 million. There was 100 million share of bonds traded. It doesn't mean they all went to the company. That just means everybody else is in the middle of this too. The guys trading this thing are buying and selling it, trying to get in front of the company, trying to, the risk they have is the company says, okay, we're done for the day. And if they're buying bonds, they may pay too much for them.
Now to get that 7 and change price for the MOAS folks that are very aggressively trying to think about like how the mechanics of the trade would have worked, it would have been very dangerous to short the stock before you knew that they were going to do this. So the short would have had to have happened when the prices were a bit higher than the 7 and change, and then probably they shorted it through the mid, right? So that probably represents the mid for those that are more on the MOAS side that are viewers. And so then once the exchange is done, the issuance of shares collapses that out. But the way that you should think of it, because I know some of you guys are going to be like, bondholders always short stock. No, this was actually it would be kind of fair. I'm going to use this word, but it's not it's not technically the right
No,
word.
they were selling shares to cover a commitment they were going to have.
No. Remember, I'm trying to say this for a specific group of people. It is actually a synthetic way to do a debt for equity swap. It's
Right. No, I'm sorry. You're correct.
Rather specific. But it wasn't. It's not like your classic. I'm a bondholder. I'm shorting to hedge against my bond sort of thing. What it really is it avoids the need to actually do something more aggressive in the marketplace with an investment banker that you're paying. So, I mean, Silver Lake probably charged them a little fee for that, but like, or whoever ended up facilitating.
I've tried to find out who it is. I can't find out who it is.
Somebody facilitated it. I agree with Sparky on that, but I just want you guys to realize that this actually can happen in a single day, even though probably you already had some bond accumulation before that. So just because we've got those folks that I know watch this and freak out. Sorry, Sparky, go ahead.
All right. Let's get one quick question from the audience in here. Von Steuben is asking a good question. And if y'all remember back, I think it was in November or December, last time they did a debt for equity exchange, both Moody's and S&P gave AMC's credit rating a SL notation, a selective or SD, selective default for, I think it's 14 or 21 days, however long they
know the answer to that, Tony. I think you've researched that.
I know the answer, but I'm curious, when you do a debt for equity exchange, it's almost policy from the credit rating agencies, since the bond didn't get paid out per the agreement, they kind of view a debt for equity exchange as a sign of distress. And so they just make this notation on the account. So whoever's going back later to look at it can say, oh, let me see what happened on that date. And then after, I think it's 21 days, that selective default notation comes off the credit report. But why haven't we seen that update from the credit agencies on this latest debt for equity exchange? Have they just not got around to updating the credit profile yet? Or was there something materially different?
The
You
answer
guys have
is
any
I don't
thoughts
know,
on that?
but my guess is it's not anything material, and it might have. This is just, I would say, an educated guess. It may have to do with them notifying the credit agencies before they do it versus when they maybe have done it in the past. They didn't want anybody to know. They just went out and did it. So if you notify, and I know this only from the debt we issue, we're constantly talking to Fitch, Moody's, and S&P for a month before we actually do a deal, and they're reviewing and doing all those things. So I have a feeling what technically they're doing is, if you do one of these debt to equity swaps without going through all the normal things you would send the credit agencies, they basically withdraw the rating until AMC thinks they're done with what they're doing, and they supply them with, okay, here's what we did, here's how much we took out in bonds, here's our updated cash, or whatever else you want to say, or we didn't use cash, we used stock, and they'll reapply the rating. And at some point, I would say, because this happened after they issued the 7.5s. Now, that wasn't buying bonds at a discount, but this was back in 22. They actually upgraded them a half a notch, if you remember. They went from like CCC to CCC plus or CAA2. It wouldn't surprise me at some point if they get farther into this buying back debt. Let's say they have a good push in the stock price and they use stock to take out another couple $100 million just over the course of months, not tomorrow necessarily. It wouldn't surprise me at some point that's going to turn into a positive event for the whole stack of AMC debt. I'm not an AMC, I'm not an S&P analyst, but it's a positive thing for the debt holders. So I have a feeling it just has to do with, only from my experience, of how much information you have to give them constantly before you get a rating even reiterated. When we've done debt deals, they kind of threw it in. They withdraw the rating completely, basically. They call what selected default. They're not saying it's going to default. They're just saying in the notes of that, what happened, they actually said, we actually view this as positive for the company. Right.
This was back in December. This is a positive for the company, but since it was a debt for equity swap, we have to do the selective default notification and check back in 3 weeks, and we'll probably have it removed.
Yeah,
I went in and read
yeah.
both what S&P and Moody's wrote up.
There
And
is one other thing, though. I'm not sure, because there is actually a debt for equity swap with a very specific creditor. I think that is still, that might be what is the original question. Not the one that originally kicked it all off and triggered it in January, February. But if it's this last little move that we got on the 8K, technically that is not a debt for equity swap. I mean, it is a debt for equity swap. Like clearly they swapped out the debt, but it's not negotiated with the debtor. It's somebody went to the open market and bought it.
And you might be completely right with that. They had a third party go out and accumulate bonds, and they figured out a math thing. You might be 100% right.
That's a good point. That's a good point.
But I'm not 100% sure, because honestly, the ratings guys do their own thing. And also there is one really weird thing about the ratings guys. They tend to only put out press releases at the end of the month or the middle of the month. It's very strange. That's what I've noticed. I don't know if they just have one guy that reviews all of it in legal and then they put out all the releases at the same time. But I don't know. I may be wrong in that observation. And actually, it's just that's the ones that have always affected me have always been right at the month end. So there's that too. I don't know.
All right. So we'll keep our eyes peeled, for the end of the month. But yeah, maybe it's because they went out in the open market and bought these instead of, swapping them with one entity.
Right.
I want to talk about Wired's question. I'm going to take it off the screen, but in general, I think this is good for people to know. What makes bonds trade closer to par? So if the bonds are trading at $83 right now and par is 100, what makes the bonds go up in value? And that dovetails into this discussion about what would help AMC get a restructuring done more easily. And I'll let either one of y'all tackle these, but I just put a few bullet points up on the screen.
I feel like I'm bogarting the screen.
A bunch of things, so Sparky can pick up the ones that I missed. How about that? Because there actually are a lot of things. I mean, the first one obviously is the total amount of debt on balance sheet. Usually, there's actually, if you go onto the S&P website, and I think I've posted it before, there's a list of exactly which metrics they're using. Debt to EBITDA in particular is one, which is why he's always giving free cash flow and EBITDA statistics every single quarter. The second thing that is 100% a function of that is the credit rating changing. Right now, I think at one point some of the bonds were double C negative, but I think that's no longer the case. I think the lowest rating is triple C minus. But
triple C minus on the second liens,
Yeah. No, but I mean on the other bonds as well, the subs, some of the subs might be, but all of them. So it depends what bonds you own. Okay. Totally right. I'm sorry. You're right. I'm wrong on that. But depends on which bonds you own, how you're going to look at the credit rating. But in general, it's in this particular case, it would be very strange for only one bond to increase its credit rating because of the nature of what's happening. There are cases where only one bond might, but you'd have to have it really siphoned off, like the Odeons have a very specific set of stuff where they get paid back. But in general, the improvement in balance, just less debt will do it. If you suddenly get, it's really, the major metrics that you're looking at are EBITDA, free cash flow, and total debt. I mean, I don't know if there's even anything else. And then
it's coverage. It's coverage ratio is all it is.
Yeah, I mean that's really all it is. Like if suddenly they end up with a lot of cash, that'll do it. If they pay off a bunch of debt, that'll do it. Because the whole point is can you pay that debt or not? It's actually debt investing when it comes to what you're looking for in the financial statements is significantly easier than equity investing in that regard, which it can sometimes be a little bit like tarot card reading.
To answer your question, May, I'm looking at the sheet I sent Tony. There's a number of debt issues they have that are double C plus rated, so below
below triple C, yeah.
But they're the ones that they exchanged. So they're for the most part they're really small. Like one or two of them are only $4 or $5 million. Those are ones they'll pay off just in cash.
Yeah,
in the next couple of years. They have the money to do that. So they're not a concern, I would suggest.
No. I only mention them because there's this one crazy aggressive troll who I think actually is an Aussie hedge fund manager. He's like always likes to post about how the bonds are double C minus or something. And I'm
Oh
like,
yeah, he's probably the same one that said, "Oh look, they got a default notice." That was that.
constantly,
I
yeah.
think it was John Himpton, wasn't it?
Yeah, I don't know why he's so passionate because he doesn't seem like he's a dumb guy. Like he seems like he's
No,
actually very intelligent.
he likes to troll.
Yeah, so weird. What a weird use of your.
What a weird use of your time. He's
Yeah.
probably short. He's probably short, May.
Yeah.
The one thing I'd like to mention, if you don't mind, and Tony and I talked about this briefly, is AMC, I don't think, has been given enough credit for when the stock did spike from $3 to 11. They didn't get 11, but they were ready to go. They obviously had all this teed up. And within a day or two of that, they, if they took out 150 million or 160 million and at $7, yeah, they didn't get the high, but they got more than double where it was 2 or 3 days before that. And I'm only going to compare that to GameStop, who took, they got a mandate to sell stock when it was at 20, but they didn't
they missed 60% of their run up.
Yeah, they didn't sell any at 50, 60, 70, 80. So yeah. I think some credit for all the people that complain about Adam Aaron and the management's trying to screw us. They got to actually just look once in a while and see these guys are fairly.
I just also think, look, the people that are doing the complaining have zero idea about the complexity involved
in doing any of this.
In doing, first of all, the paperwork.
Yeah.
Doing the deal, going out and having an entity buy all the bonds. Like the amount of work, it's not just like you punch a button and, let's sell at 11. It does not work that way. And that's why I wanted to do this live stream. So maybe those people could come on here and ask a question like, why didn't AMC sell at $11? Well, what do you know about the process of how this gets done? Or are you just making generalizations because it makes you feel better to be angry? Like, how about learn a little bit? And that's why I have May and Sparky on here. But, I don't see these people in the comments asking any questions.
I see 2 comments on here I want to just go to. I have, does Sparky have a channel or Twitter? The answer is I don't have either one of those because I'm just a bond guy that happened to, become friends with Tony, and he helps me with options and stocks and I help him with bonds. And the other one is May is one sharp cookie, and I will agree with that. I had not talked face to face with May before, but I've watched some of her videos. Well, I'll second the sharp cookie part. But no, I don't have a channel. I'm not interested in doing this. I see the work Tony puts in behind it just for today's thing, and I'm like, I think I'll stick to my regular job. And if he wants to have me on once in a while, I'll be happy to do it.
I only know Sparky, guys, because he's always commenting on my videos, and he's been trying to get me to understand stuff because I'm not a bond expert. You guys know that. I've said this many times.
And I'm not trolling you either. I'll just say, hey, think of it.
No, I know you're not trolling me, but you're trying to educate, and I see you get a lot of pushback. And
I get trashed. It's probably gonna be worse.
Yeah, I mean, anyone that's trying to educate always gets trashed by the conspiracy people because they don't want to actually learn. They just want it their way, no matter what. Everything's conspiracy. Everyone's against us. There are many logical and financial reasons why everything that's happening is happening if you take a hot minute to try and learn. But I appreciate people like Sparky that try and comment on my videos in a respectful adult way. Hey, Tony, here's something you ought to think about. And when I get those messages, I do try and think about it, as long as it's if it's you're a clown or you're a drunk, those people just get blocked. But Sparky,
the way this all started 2 weeks ago is you reached out to me and said, "Can you send me what you're talking about?"
I always want to hear from people that have differing opinions, because that is how we all learn. That's why I love even having bears on my channel. Like, tell me what are you seeing that maybe I'm missing?
Don't call Tony a clown either. That's a really scary thing. Clowns are very, very scary. It's really mean. Sorry, I couldn't let that go.
I'll probably be messaging May after this going when people start hammering on me on YouTube and say, May, I don't understand this. How do you handle it? People are trolling me. That's trying to be nice.
May's very good at handling the trolls. She puts up with them. I just block them. Like, I don't got time in my life for that.
To a point.
If you can't be an adult, block. All right. Was you had, you said you had 2 comments you wanted to address. So you got both of those.
Okay.
Sparky. May, you talked about the first 2 bullet points on your, what would help AMC? And this is to Wired's question also. What gets the bond prices up or getting the bond prices up? I think we covered maybe 30 minutes ago, could potentially help AMC get a restructuring done. Because it, what's the right way to say it, Sparky? It just gives them the ability to go out and buy it.
Well, no, it's actually
without having to negotiate.
If the higher the price they can get, the closer they can get it to par. They no longer have to rely on going to negotiate a price with holders. They can just call it. It's their option.
Okay.
That's really the key. And they can take things all out at once. They don't have to one holder at a time or a bond group at a time. Hey, we got 52 million. What would we pay for it? No, they can go call 400 million.
Okay, so why can't they call it right now? It's trading at 83. Why can't they call it right now?
You can't refine. You can't do a new issue to pay for it. And
why not?
Because if they're trading at 83, that's roughly 20% or 19%. I don't remember what it was.
Yeah.
If the market's only willing to pay 19 or 20% for your subordinated second lien bonds right now, and they trade a lot. It's not like it's a not defined price. You can't all of a sudden go out and issue a new 5-year bond to refund them at 8%. Because the market has established that the yield is significantly higher than that.
Yeah. So just to help people a little bit too.
I'm trying to help ask questions to get a layman's explanation here.
Yeah, Sparky's 100% correct. It's like this. If you go to the bank to get a mortgage, but right now it looks like the only rate that you could ever possibly get was 15%. Even if the mortgage rates are much lower, they will not give you anything but 15% because like a bank, you got to realize like a bank is beholden to its shareholders too, right? So if the debt markets are saying, hey, I think these guys are probably a credit risk that would imply that you better be charging them 15% for their debt, then 15% is the number. That's why I think Sparky and I are both really passionate about the idea that they should try to get rid of those 2 L's that are trading so crazy, and that all of the debt trading at such a crazy discount makes it's not great for renegotiating the debt.
Yeah, and the more they can take out the weakest link, the more they can take out those subordinated bonds, especially the 10s. If they can get rid of them, and there might be a little pain for stockholders because in essence, they're probably going to do it with stock. First of all, it's a great return on capital for them doing it. But if they can take that out, they have much more leverage going to refinance the rest. Anything else they have, the $700 million they take out will help them refinance $3 billion in total debt they have over the next 5 years they got to deal with.
I think that's also another point that people that have no financial background, that maybe have never taken a finance or accounting class, it's easy to miss how buying what you just said, that it's a great return on capital.
Right.
Can you just maybe break that down like you're talking to a senior in high school? Like, how is that a great return on capital? Because people just have a problem right now that the company's spending cash or issuing equity because they don't understand how it is a great return on capital.
Well, think about if you have these arrows in your quiver where you have the ability to sell shares, and it's dilutive, but you have the ability to, at the market price, raise capital. If you can buy your debt back at 80 cents on the dollar, that's due in only 18. It's less than 2 years. It's April, I think, is the first one, April of 26. So that's 20 months or 22 months. If you can buy that back now, if you can buy 100 million of it back now for 90 million, you're pocketing that 10 million, but more than that, you're also not paying 10% yield coupon on that.
Right. So if I can just interject for 1 second to interject, what you're basically saying is that in 18 to 24 months, they're going to have to pay the full amount to the bondholders.
Right.
But right now, they're actually not only getting it for 20% less, they're also not going to have to pay the coupon, the interest payment to the bondholder for 2 years because they just paid it off. And on top of that, I was going to say they're not going to have to pay interest, but that is the interest. So.
Here's a more simple way to think of it. This is it coming from a stock side for me. If they're, let's say the next 2 or 3 quarters, they have a marginal profit or a marginal loss. If they take out 800 million, to use a round number, of 10% bonds, that's 80 million a year in debt service they don't have to pay. Well, if they would have lost 25 million for the next 2 quarters of the year, but they're making 40 million of that back because they're not paying interest, that means you turn a loss into a profit. And then all sorts of doors open up for the company. If they go from being marginally unprofitable to profitable just by doing this, that's the greatest use of stock capital to retire debt probably there ever is.
It might even be what some would call smart dilution.
Yeah, and I'm not an AMC bull too, so I mean I'm not a bear either, but I'm fairly indifferent because I don't own it. But that's an excellent use of stock. You're going to have to raise it to pay the debt in 2 years at par anyway. Why not do it now and pay 80 and save yourself a year and a half of 10% interest?
What do you think about that, May?
Here's a third way to think about it that might help for folks that really it's just too much math or something for them. If you look at yield to maturity, right? Because that'll really give you what you'd be making each year on the bond if and this is 2 years out. So then you don't have to do the math. You can just use yield to maturity, which is still for the 2Ls around, as Sparky mentioned, about 20%. Is that right? What's the yield to maturity right now on the 2Ls, Sparky? Okay. It doesn't matter. Whatever the yield to maturity is. So even if I use the 2025s, right?
The 2026 are almost 20% yield.
Okay. So if you think of it this way, it's kind of like people that have told you that when you pay your mortgage down, it is the same as taking in that as interest rate. So if you had a 5% mortgage, then you make 5% because basically you no longer have to pay that 5%. So essentially what the yield to maturity is also telling you is when the company goes and buys it, it almost immediately makes 20% on that purchase, right? So even if, and they're going to use equity to do it. So yeah, there is dilution, but they make 20% for shareholders every time they do that activity. Yeah. And in some cases, if you realize too, that when they did this activity in December, they were making closer to almost 35 plus.
Oh, they were buying bonds in the mid 60s. They were buying the same bonds. The bonds have run up because the company is doing this. Yeah. Which is actually good for the company. That's what's interesting about this is people are critical of all this, but they were really killing it 6 months ago when they were buying them at 60 or 70 cents on the dollar. That's
the most aggravating thing for me is what they are doing is actually laudable in terms of what they're doing for shareholders, but we get so wrapped around the axle about the word dilution that people can't even understand the beneficial side of it, right? Everything, it's like a scale, right? You're getting diluted, but that was actually fine in the world of finance, a very smart use of shares.
Yeah. I mean, you're making over 20%, and that's for a company that is going bankrupt, that's not a bad investment to make. But the nature of the 20% is very long-term oriented because first of all, it's at a minimum the time period of the debt, right? But then you have also the fact that you now, because you did it with equity, you didn't use any cash to use it, you get to keep your cash. So even if you only thought about it as, well, the bond yields 20 to 30%, depending on which time period you're interested in thinking about it, you have to also think that you keep the cash, which is really, really a big deal when everybody's attacking your company like crazy.
And let me just throw out one other thing to the people that are complaining about the dilution. And I get it. Look, I understand why you're complaining, but what answer do you have? What option are they going to do in 2026? We're not going to make 2.9 billion. We're not going to make 2.9 billion in profits in the next 24 months. So what do you want them to do? This money is going to come due. They will force the company to file bankruptcy if nothing is done. So if you choose to remain in the play, this is the cards are on the table. There's only so many options. Tell me in the comments, what do you want them to do differently? You want them to raise more money. You want them to cut costs. All right. How are they going to cut 2.9 billion in cost? Tell me your plan. It's easy to throw stones and complain, but we're trying to have this conversation to help you understand. And if one of y'all is a accounting whiz and you've come up with another way to do it, I'd love to hear it. But this is the play you're in. So it's better for you to understand it. And then you can decide to stay in or get out. But you got to this is it. I mean, they're not going to make 2.9 billion in profit to pay off all this debt.
Hey, Tony, can I answer a question in your chat from Anya?
Absolutely. Yeah.
Anya put out there, why would somebody that holds the debt
I have it on the screen.
Sell bonds at 80 or 85 cents versus waiting 2 years to get 100 for them?
Yeah.
And the answer is really twofold. First of all, there's a lot of trading in this debt, especially when it's really beat up like this. And don't forget, this debt was 40, 50, 60 cents on the dollar just a couple months ago. There's certainly, high risk funds that went and bought some of this debt at 40 or 50 cents that now it's at 80 or 85. They're going to sell. They're happy to sell this, whether it's to somebody that's selling to the company or not. And they'll go find another, their job is to find 100% equity return type things, not clip that 10% coupon. So they made if they bought it at 50 and they sell it at 80, they're going to make that big return, and they'll go on to something else.
Does that make sense, Anya? I mean, these bonds were trading for much less a year ago. And so someone could have bought them. And like Sparky said, they're happy to roll out of it.
Even somebody owns them at par, they're up to 87, might say, you know what? I don't like the prospects. I'm not sure this is going to work for AMC. I had a 50% loss. Now I only have a 13% loss. Same thing. I'll take my little bit of a hit and I'll go find something else to do. I mean, there's all sorts of holders in the market, just like stockholders that trade them for different reasons.
That's a good question, Anya.
There's another thing related to that. Remember, the bonds are still CCC rated.
Right.
So depending on what the bondholder wants for their composite portfolio, this isn't the only bond that bondholder owns. So depending on what they want in composite. Now, we had this beautiful activity this last few days, which probably is why people sold. I mean, some of the bonds traded all the way up to where, they're all the way up to where. So really quick, just to clarify, if without getting into the details, these bonds trade at a discount even to their rating, which means the specific risk of the company, the bond market is still pretending like that's pretty significant. Because they trade at such a discount, during this little rally that we had in the bond market this last few days, so it traded almost all the way. The discount actually decreased dramatically, which means that if you're a bond manager and you just really actually wanted to you wanted to high grade your credit risk in general, meaning you didn't want whatever the composite of your bond portfolio was, you wanted it to be a higher credit rating, then you had incentive to just get rid of the lowest credit rating bonds, which would be these AMC bonds. So it's hard, that's maybe a little bit more detail on what Sparky is saying as relates to the fact that everybody has a different reason for why they're owning them. Hopefully that helps as well.
That's why Tony has you here, not just me rambling on, diarrhea of the mouth.
All right, let's King Arthur has a response, I think, to the question that I just posed to the camera a second ago. And I hear, some of this similar talk going on right now with the GameStop crowd with their ATM and their shelf that they just filed. He says, how about just get an offering ready and let the price run up and sell it when it goes high and pay off as much as they can without all the wet blankets, like without
I think they
$4.
they have a shelf. They have the ability to sell shares.
We have an unlimited shelf up to the current authorized
Right,
shares.
but they're not going to be. They still want to manage that. AMC. The best thing that can happen is, okay, yeah, we ran up to 10 or 11. They'd love to have something good come out of not just Roaring Kitty, but something progressive. Box office gets better in the third quarter and numbers look better. The stock will run up on its own. That's when they want to, bleed out some shares, not kill the rally, but sell a little bit at a time. They have the ability to do that, but they can't just dump 50 million shares on the market.
Well, what he's saying is, why can't they just wait for the MOAS?
They
just have the shelf and the prospectus ready. Wait for the MOAS.
They kind of have that. I mean, they have it.
In the dream world.
All they need is a $50 price. Trust me, they'll sell as many shares.
Yeah, I'm rooting for the MOAS. You have no idea, because it's in my interest. It's in everybody else's interest that's watching. I'm in the subs. Okay, I'm not in the 2Ls. I'm not in the first lien. I'm not in the Odeon. Right. I mean, I own the 2025s, which I think trade stupid right now, but that is what it is. But I also would love for the equity holder to do well. Like, that's the nature of that particular bond. But MOAS away, guys, please. The higher the better, because
this actually brings up a good point for common stockholders, like, people that are buying the stock like myself. And we talk about this all the time on live streams and in the Discord. I fully expect, just like GameStop did when their price ran up, they're going to drop a prospectus to sell shares, because right now their stock is, GameStop's trading at 3 times the fundamental value, according to analysts. And GameStop CFO is not stupid. He knows what the fundamental value is of his stock based on their earnings. He's not listening to YouTubers saying that the stock's worth $1,000. He's like, here's our earnings. Here, it is what it is. And AMC CFO is the same way. They know what the fundamental value is. And if there is any price run up, I just automatically expect any of these companies. In fact, I made a video about it a year and a half ago called the CEO Handbook. If you are gifted by the market unexpected price increase, your first response, if you need money, should be to drop a prospectus. That's like Finance 101. So guys, they're not trying to kill your short squeeze. They're being good managers of the business and the balance sheet.
I mean, I would mention too that if they pay off the 400 million, like, to me, if they kept doing it after the 400 million was paid off and they were cash flow positive, then I'd be pissed. But that's not where they're at now. I would love to see them get the 400 million. Just remember, Adam Aaron is paid. He has a ton of stock. So he wants that stock price up. And the fastest way that he's allowed to do that is pay off the Odeon so he can start buying back stock. If I had to guess, I don't have a crystal ball. I sure as hell have never talked to Mr. Aaron, but if I had to guess, he wants to pay off that 400 so he can start buying back stock so that he has control over the price of the stock. Right now, he does not have control over the price of the stock. And if I was a CEO being paid in stock, that would piss me off.
I would back what you're saying by just suggesting that, and Tony, you and I have talked about this forever. If they can get this thing turned around, maybe not in 24, but in 25, where they actually are having positive cash flows, even a little, that completely changes everything, because they don't have to swap any more shares for debt or anything to get to the point where they're just making a little bit of money. It doesn't even have to be a lot. Just cover all your stuff, have a little profit. Then that opens up the doors to do all sorts of things, and they never have to dilute another single share.
I want to just divert the conversation just to, for 1 second, to what I hear people, slamming on this company for. Oh, you have $4 billion in debt, or $10 billion if you want to count the lease liabilities. Let's just concentrate on the debt for a second, because the leases are the leases. They're saying that this company will never be profitable. The bankruptcy is guaranteed. There's no way they can pay off the debt. My take on this And I think the people that are saying this stuff really understand zero about finance, or they have no clue what they're talking about. And you guys are way smarter than me, May and Sparky, so feel free to correct me. But the amount of debt is irrelevant if the company's cash flow positive and can service the debt.
Absolutely.
Yeah.
AMC could have $4 billion in debt for 20 years, and nobody on Wall Street is going to care if they're booking profits and can pay the coupon.
And then when one comes due, they'll have the ability to go out and refinance it, whatever term they want, if they're covering it.
That's why when I hear someone say, "But you have $4 billion in debt," I already know you don't know what you're talking about. That it's irrelevant, the amount of debt. The problem right now is the lack of profits.
Yeah. Cash flow. Because profits, might look, I mean, you know what I mean? Like, yeah.
Cash flow, profits, I mean, hand in hand. Once you have profits and cash flow, you can start whittling down that debt, and nobody's going to care how long it takes.
Yeah.
If they're going to see that you're making progress, and that is always a good thing.
And then exactly what May's biggest point is, when you get to that point, those 12 3/4 bonds, even if at that point they're trading at a premium, the company's still, let's say they're trading at 106 and they're at 10 or 11% yield, but the company's profitable. It makes perfect sense for them to go out and take a portion every quarter of that profit and go in the open market and buy back those bonds. And
that's what I'm talking about. You take some of that cash flow and you pay off part of that debt. I mean,
it doesn't have to, it could be a little at a time. I think I probably reiterating what you said. And every time you do that, you're taking future liabilities and future income or future payments off of your income statement and making your income go up.
You're strengthening the balance sheet by taking debt off of it. And I mean, all of that is going to pay. It's going to be positive for the stock price, but is it an overnight process? No, it's not an overnight process.
Yeah. I mean, for me, I don't do estimates. As you guys know, I just commentate, but I actually do agree with the higher end of the range for 2025 as far as like what the free cash flow looks like, meaning they should not only, if they don't do another, exchange of some sort, they'll either be able to pay off the ODN or buy back stock. So that's why I'd almost rather them go ahead and take care of it this year, so that next year into it, a very big box with a lot of announcements, you also have money to buy back stock.
And think of it just this way, whether I still think they're a little ways from buying back stock or doing a significant dividend. Maybe they do a penny or two to keep shareholders happy if they're marginally profitable. But
I don't want a dividend. I want a stock buyback.
Well, but for the same reation, because they're still pretty leveraged. I mean, I've seen, depending on how people do it, 8 to 10 times levered. If you talk about use of capital, if they take out these 10% bonds, and it's $800 million, they save $80 million a year. They literally could go take that $80 million, buy those 12 3/4 bonds back at whatever price they are. Now you've multiplied that. You get rid of them, or at least a chunk of them. Now you're talking stock buybacks. You get to a low investment grade rating where they're issuing debt at 50 over treasuries, not 10 or 12%. You're talking about a mind-blowing difference in financing. And then you go back, all these shares they've issued, you're 100% right. They could start a program of buying that back.
Yeah, right now I agree with Wired in the comments. I would be personally not very happy if I see AMC doing a dividend or a share buyback, because managing the cash that they have, to see them through the next 18 months.
They do have to pay the accrueds, to be honest. It's not cool to just never pay those.
This is not an 18-month thing. I'm talking a couple years down the road if everything works and they're making profit.
I feel like they got a shot because, I really think that 2025 looks interesting. And, I don't know. I think you've got a shot in part of 20.
If they make $300 or $400 million, which is certainly in the realm of possibility, if they have and Tony, you run if they have a box office that's $10.5 or $11 million,
they'll make it then at that point.
They've trimmed all this interest cost and they've done other things that And I'm not talking about popcorn. I think that stuff is silly, to be honest. It might be marginally profitable at some point, but you're right. If they get that $11 million box office, it's conceivable they can make $300 or $400 million in profits. That's an entirely different,
totally different
game in 18 months from now into 25 than we are now, and they can do all sorts of things.
Anya says, what would we got a bunch of good questions teed up, so I want to try and get through these. Anya says, what would a creditor get if AMC went bankrupt?
Almost zero in AMC.
Yeah, AMC has almost no assets, Anya, other than what's on the balance sheet. And
that's why I always thought what's his name, the Hempstead, the Aussie guy. I never understood. Like, I asked him that so many times whenever he trolled my account, and then we just like stop. Like,
there's literally people that have YouTube channels that make videos saying the debt holders want the company to go bankrupt. Like, it's the dumbest.
I mean,
it's the dumbest theory ever.
They're not a manufacturing company that owns factories that are paid for it, even if they're levered up or something. They don't have a couple $1 billion in assets, hard assets anywhere. They have leases on theaters, and they probably own the equipment, but that's, how many millions of dollars, not billions, is 6,000 projectors. It's not worth anything.
I think the only out of nowhere person, and it would literally be like one or two, and that would be it, would be if there was a deal that was done for, I think, the US side of Regal. If for some crazy, ridiculous reason, those private equity guys somehow wanted to do something crazy on the bonds, but the bonds don't trade cheap enough for that to be interesting.
Right. That's the problem.
I'm saying at this point, if the bonds were a lot cheaper, then maybe, but at this point, their bonds aren't cheaper.
Well, one thing, I mentioned this to Tony, and I have no idea if I'm right, but I'm not sure. You look at the Odeon, they keep that debt separate. They've never rolled that in. Let's say Odeon, British movies take off, whatever, and that becomes a valuable subset of theirs. I'm not talking about tomorrow or next year, but let's say it turns around faster there than it does here. That's an asset they could sell. Right now, it's not an asset on their book that's worth anything, but it seems to me they've kept the finances, at least on the debt side, separate and tied to that group. That makes it easier to unwind it. And again, you never know what it is. You're talking about private equity. Maybe somebody in Britain says, hey, we want a theater company. We'll pay you $1 billion for it, and we'll assume the debt. They're going to say, here you go. I'm not saying that to get anybody to say, oh, that's going to happen. They'll, Tony, you're better. This is my first YouTube appearance. So they'll probably say, this guy's saying they're going to sell Odeon. That's not
because the other thing, Sparky, too, is that you need a management team on the other side that can deal with it. You can't just like randomly buy something and then pray you get a management team that can handle it. It doesn't work that way. That would be the only reason why I would ever think that there might be some really convoluted thing that private equity is doing, is only because there are a couple of private equity owned theater companies, but it's so random and it's so weird if they did it.
Here's the thing, and you understand this too, May, is right now the valuation for theater companies, whether they're here or overseas or whatever, are not very good.
Not great. Yeah.
if that turns around, and it can, all this stuff is cyclical, and if all of a sudden there's a big bid for, I don't remember where they are. They do. I don't know if they have anything really of any substance, but that's what I'm talking about. At some point, if something gets crazy in some other market,
maybe
it's possible that but it's 100% possible. Somebody,
you never know. You really
pays you 3 times what you think it's worth for it because they want it. That's not today. That's not tomorrow. That's not 2025. But if you keep this whole thing going and then you improve it, and the market in general there'll be a cycle somewhere where somebody will pay some stupid price for an asset you have and you sell it to them, unless you really need it.
Art says, why do we have to raise $2.6 billion in 2 years? Can't we just refinance the debt and push back when it's due? That's
kind of what they're trying to do.
That's what we're talking about. Yeah. Restructuring the debt.
Yeah, they won't have the money, and you made this very clear. They won't ever have the money, and they don't. Even a good company is never going to say, "Hey, we're going to have $1 billion in the bank. We're going to pay off debt." It's always about, can you refinance it and roll it out to where you want it at a rate that still makes sense, and if they're in better financial condition now, or in 25 than they are now, they'll have no problem doing it. The challenge they have is getting there 12 months from now to where they're
Yeah.
hopefully improved, and all sorts of avenues will open up for them.
Old school tandem skydiving says, in your opinion, is a short squeeze still a possibility? I just generally have a rule that I just say if it's over 20% short interest, then I start getting interested in the possibility of some short squeeze. But for me, it's got to be over 20%, and you got to not be diluting, because every time you dilute, you're bringing that short interest percentage down.
I think some sites are updating, with the shares they just swapped and sold, the 72 million they sold and the 23 million. Some sites are updating where they're showing the short interest to be in the 13 to 14% range. And I think that's right. If the short shares are really 50 to 52 million, whatever they are, over the new share count is really like 350 or 360 million, that's 13%. It's still high, but that's not,
I'm just saying, for me on YouTube to talk about to use the word short squeeze, my just general channel rule is I want to see it over 20%. You can have run-ups in stocks with 6% short interest.
Right.
If you get just look at,
guys. That's what I'm saying.
Look what happened last week. AMC ran from $3 to $12 on Roaring Kitty videos.
And GMA went from 10 to 80.
I mean, these are why I like speculative plays. I don't make it the bulk of my portfolio, but it's the thing that makes it fun to wake up every day and see what's going to happen. How can I get the best entry and be positioned for the day like something when last week happened? So
I will say something, and this is, if you don't mind, Tony, because this was a discussion again you and I had, not being a current AMC holder, but trying to figure out how I can get in 3. I did 2 rounds of selling $3 puts. I made 40 cents on one and 20 on the other. The thing I learned, and this, sometimes the pain isn't from taking a loss, it's from missing something, is I would have been better off. My share bite at $3 would have been 3,000 shares or 2,500 shares. I really should have bought my initial purchase. I should have bought them somewhere $2.90 to $3. I don't try to pick the bottom. Had a base, and then sold puts. So if I got hit, my cost would have been 2.5, and maybe written calls against it at 5 and taken the 50 cents. And the worst thing that would have happened is I would have made $2 plus the profit, but I couldn't do any of that because I never got into the stock, So
you weren't thinking about buying it when it was at that price.
No, I was messing. I mean, admittedly and painfully, I was toying around with, I thought the options were so expensive that I'm like, well, I'll sell that $3 put because I have cash to back it up, and I got 42-cent premium for only 3 weeks.
That's pretty. Oh, for 3 weeks. Okay.
No, but
if you got that for a week, that's pretty good.
No, but it was for like 3 weeks or something. I did the monthly. Well, as it turns out, the stock ran up, and I didn't wait for expiration because you still have stock. You still have risk it can turn around. But so I bought them back for 3 cents or something.
Well, nice.
Well, yeah, and I did it again, but I only got 20 cents because the price was higher. And that one I let expire. It just went away. I think that was the May 17s or whatever they were. But the point is, I made a free $1,200. But I also, if I just would have bought 2,000 shares, and I wouldn't have waited till 11, I would have bought 2,000 at 3. I probably would have put an order for half of it at 5, and a quarter of it at 7, and a quarter of it at 10 or something. And so my average out, because I'm fairly disciplined about that, would have been $6.50 or $7 or something. But I didn't get any of that because I was dinking around with trying to, get 2.5 instead of 3.
Okay, we've all been there, Sparky. Don't worry, we've all been there.
Like I said, that was a painful lesson. Like, buy the stupid stock first, and then start messing around with options. I think are too expensive.
Wired Ape says, "Can we all agree it's not dilution that brings the price down? It is the cash burn because of lost revenue due to the low box office."
That's probably a little bit of both.
Yeah, I would say Wired.
One cause.
My answer would be both.
Yeah.
I mean, you see the immediate reaction to a dilution announcement as soon as the 8K comes out or the prospectus. And then the box office. I think the market is very good at listening to analyst predictions for box office. And so you're seeing a price that's like looking at box office. Some of them are looking 3 months out. Some are looking, I think, at the whole year. And maybe, you know, I say we, all the traders that I talk to that follow AMC as close as I do are expecting a little bit of push up as we move into Q3, because we're expecting the Q3 numbers to be really, really good. So if part of it is due to box office, I expect that to be, you know, to get a little bit better as we get into Q3 or start even getting close to Q3. But maybe we got to get over the pain of Q2 being a little bit worse box office than we were expecting.
But the market does always look forward, though, too. So I think they forget about Q2 really fast.
I do too. As soon as they see those Q3 numbers,
just
not
for
really going to
timing,
matter.
this didn't work out. But look at Q3. We actually have these movies, and they're killing it. People will forget about Q2. And
yeah, as soon as we know that the company is going to turn a profit for Q3, the Q2 numbers are going to be kind of an afterthought.
It won't matter. Yeah, I agree with that.
But yeah, I think when dilution brings the price down, and then you just deal with it till the dilution's done. And then slowly, as we forget about it, the price starts creeping back up.
You know, as we get closer to the timing of Q3, though, that dilution is mostly going to go to cover the shorts. It's not going to be new shorts resetting, because really right now, I mean, if you have 13% short interest, even though that's not the classic 20 where you really start to get into short squeeze territory, it is actually weighing on the stock, the price of the stock. It is depressing the price of the stock every day of the week.
And I would agree. Any sign of actual better numbers does make people cover. Now, I don't think it's a pile in MOAS, but it will make people, for the same reason. If you're a long short fund, somebody will go find a different opportunity they like better. You know, how much more can they squeeze out of AMC? Can it go from 5 back to 3? Well, that's not real dramatic. They go pick on something else that they think is 80% overvalued.
And I watch Cinemark and IMAX too, and they're not exactly killing it right now either. I think because Q2 expectations, but I expect all of them to get a little bit of love as we get closer to Q3.
Yeah.
Tubby says AMC theaters are in need of upgrades. There is a risk they need to put up money for the renovations. May, do you want to talk to the CapEx for a second?
$250 million. That's it. That's what he promised to spend for a while. Okay. You spend 250. You said 250. I will not be happy if you spend more than 250. That's how I feel about it.
I feel like they're at bare minimum maintenance CapEx with the 250. Wouldn't you agree?
That in 2026 after I see your 25 numbers. That's how I feel about it.
The other thing I kind of worry about. How do you really
feel about that, man? You don't seem particularly adamant about that. Is that really how you feel?
Maybe if you have a really good 2025 Q1 and Q2, I'm cool. But like, I need to see your 25 before.
Adam talked in a recent interview that I read about the need to upgrade some of their prime properties. Like he mentioned one venue in New York, and I don't remember how much he said it was going to cost, but it was an astronomical number. And let's just say it was $20 million. And he's like, we're looking at upgrading 5 of these theaters, bringing them, you know, up to our current quality expectations. But we've got 40 of these prime locations that we need to eventually get to. And I'm like, wow. I mean, if you sit and think about what they really need to spend on CapEx, I guess I'm just thinking, May, when we get into, if the company gets into a year where they're throwing off a lot of cash, they're going to re-up that CapEx number to something higher to catch up on all the renovations they need to do.
But I think that's okay, though.
Yeah. I mean, it is okay. They need to. You can't just let your properties fall behind the competition.
Yeah, I mean, if it looks like the box is going to come higher than, let's call it 10, because 10.5 already puts them back at profitability equivalent to 2018, and at that point they had operating cash flow of like close to 600, but they were running about 500 in CapEx. Right. So let's say let's say, so there's not that much free cash flow, but if you said 250 and you're doing almost 600, that's a huge spread. So then if we know that that's what it's starting to look like in 2025, I'm super cool. But if it's not even close to that, if you come in Q1, Q2, first of all, I'll be horrified if you come in Q1, Q2, and it doesn't look like you're even remotely coming close to that kind of box. But like, but you know, if it's clear that you're going to actually cover the, you know, closer to 10.5, which is where I think, I mean, that's the new number, right? To make the same profitability. If I'm right, Tony, I don't know.
Richard's asking why restructure now instead of waiting another year. And I'll throw this out to you guys, but I'm going to add a second question to it. Not just restructure, but why do debt for equity swaps right now versus waiting another year?
You can't wait that long. You have to do it a little at a time.
Why? Why do you have to do it a little at a time? I'm gonna pull the answers out of you for the audience.
I think you can't wait. If the one bond is due April of 26, you can't start. First of all, you have no idea what your stock is going to be at that point. I mean, it may be higher, might be lower, but you can't, you know, they're doing these little $20 million share dilutions. Hopefully once a quarter is all they do or whatever they're doing. You can't do 200 million shares to raise $500 million to try to, you know, pay down that debt 3 months before it's due, you know, and you have to be working on this problem now, which they're doing. They've been working on it starting last year. They've been doing a pretty good job working on it.
I was, you know, some time ago, many months ago, maybe even a year ago, doing some research on this. And I found a guy that specializes in advising companies about restructuring like this. And he said, you need to be starting this process 18 to 24 months before the debt comes due, because if you wait, the shorts are going to, they're going to pounce on you.
Yeah. And then you know, right now, any given day, look how long it took them to sell the 72 million shares they did. Tony, you and I talked about that a little too, because I think, you know, maybe they didn't in that was a cash rage, not against bonds, but they didn't have to try to dump those all in a day or two. I think they took a couple of weeks to get that.
They took like
completed.
They took like 5 or 6 weeks, a lot longer than I was expecting.
But that's because they're managing it. You can't go in to try to do that. Look, okay, so if that was 6 weeks and they only sold 72 million shares, you can't sell 200 million shares in a month.
Yeah, I mean, they do it slowly like that so that they don't push the price down.
Right.
You know, if your question, Richard, is more like why not 2025 versus like 6 months from now, I could see that being maybe a thing, but it is really dangerous to wait until Q3 and Q4. You definitely would never wait until 2025 because you're basically coming low stacked into a negotiation room, and that just would be really stupid to do that. You might, like, between now and and Q4, if there's another like massive rally, if that's what your concern is you're passionate that there will be one more meme rally, then I can kind of see why you're asking that question. It could go kind of either way. I think that's a really like, you know, no CEO or CFO is going to be banking on a meme rally though, because they really sometimes they you know, as frequent as we've seen them in recent history, they are very rare in the history of all equities. It's not as common as I think some people might think.
That's what I try and explain to people on my channel is management of these companies, not just AMC, GameStop, all of them. Unless they're planning all of these run-ups, like unless Roaring Kitty putting out a week's worth of videos was planned by Ryan Cohen, these companies are not planning their business around short squeezes.
Yeah.
They're planning their business around, we know what the fundamental value is of the stock. We can look at analyst reports. And if we exceed that price for some reason, or if we get into a good earnings quarter and the price runs up, then we need to take advantage. We need to strike while the iron's hot. But I don't think that they're sitting here planning like Well, we got the paperwork, Sean Goodman. Adam, I've got the paperwork ready. When's that MOAS going to happen, buddy? They don't, their board meetings aren't operated that way. They're thinking like rational business managers. Not like us.
I don't know if that answers or satisfies Richard, because I do know a lot of people do feel, and I appreciate why they feel the way they do. Like a lot of people really do feel passionately that, especially if you're more of a MOAS, momentum trader, that sort of thing, they feel that it could have been anticipated that there would be a meme rally, and I can appreciate why they feel that way. It's just a very different style of thinking than the CEO of a company would do, because his risk is that what if you're wrong? Then I'm completely screwing over the entire company.
That's the unspoken thing, is like, what if it doesn't happen? Then they're screwed.
Yeah.
I can take Frank's if you don't mind, because this is actually something May has jumped on a couple times, and I think she's 100% right. Is, if interest rates come down 24 and 25, which I think is fairly widely expected, is that better to restructure? The answer is yes. It probably will be. You probably will have a better high yield market when rates overall are lower. Everybody's chasing yield around. With the only caveat to that, I would say, is you still have to be working now. These little chunks of taking out 100 million or 50 million here and there lessen the amount that you have to reload in 25, and it makes that negotiation so much easier if you've reduced your interest expense and your overall nut, and the amount you have to refinance is lower coming into 25 when your numbers are better. You're going to have a much easier time. Do you have any? May, that's kind of what I think you've said.
Totally.
Talking about in terms of rates dropping helps. It absolutely does.
Yeah.
Michael says GTN paid off 53 million, then announced a dividend and refinanced their bonds through 2029. I don't know anything about GTN.
Yeah, I don't know that company well enough.
I can take a look at it after we're done. Chris says, any take on swaps? So there's a
nuts.
There's a narrative on social media that I think the date is June 7th. Someone made a video, May, saying that there's
the equity swap. Sorry, I was thinking about
$83 billion of swaps that have been kicked down the road, and they're all coming due on June
remember
7th.
Like February 1st, February 1st, that was a pretty widely circulated YouTube thing that there was trillions. Yeah. And remember when the date came and when it was February, I think it was Valentine's Day. It was February 14th or 15th. And then when that day came and went, they said, they pushed them all. They rolled them all out 2 months.
Yeah. And that'll be what happens. This date's going to come and go. In fact, I thought about tweeting today that I would take bets that nothing's going to happen on that day. But I mean, what if I'm wrong?
No, I mean, like, that's not that instruments, the equity. So I thought you were talking about the credit default swaps, but the equity swaps instrument isn't. I mean, it's really just linked to the price of the equity. So there wouldn't be anything that the roll would create.
Right. I think the people talking about it, unfortunately, don't really understand what an equity swap is, man.
Oh, sorry. So there's two sides to that trade. So all would happen was you just collapse the trade, and that would be the end of it. It wouldn't even touch the equity. So there'd be no reason to I mean, I know there's a lot of passion around these swaps, but the swaps only matter to the extent that there's other derivative instruments on it. Otherwise, that thing just collapses and nothing happens.
Yeah. The entire reason people do them, a big hedge fund or even Vanguard or somebody, is they do a total return spot, let's say on Apple, because somebody's willing to take the other side of it as a hedge or whatever. But all of that happens without having to buy or sell 100 million in shares. So it actually does the opposite. It doesn't affect the price as long as one of the counterparties doesn't default. It protects them from having to actually go buy 100 million shares of anything.
Yeah. I would say, the people that are putting out this information, have them walk you through exactly their thesis. I found this hidden file on a Discord, and it shows all the swaps, and this is gonna cause MOAS on June 7th.
I mean, the thing with swaps that would be exciting is only to the extent that you have really gigantic moves like we had the other day. And I did post a note, and it is the case that because you do have these, you do have indices that are created just on the memes, which there's ETFs apparently on the memes. And then there are folks that are just trying to hedge using a basket of meme stocks. So big moves, yeah, 100%. That's going to affect all of the meme stocks together these days because of how that particular weird part of the market is working. But just the rolling of a swap, I'm not convinced that actually does anything but either just close the trade out or
it does. I don't think it does. One of the parties is going to be in the money versus the other party, and all they settle for cash. That's the whole idea of what they're doing. It's a total return thing. They settle it, and if they put on another one for another quarter, then it's brand new. They do it again, but it gets settled for cash. That's why they do it. There's no shares exchanged.
Yeah.
What other questions y'all got? And while they're waiting, May or Sparky, anything as we're having all this discussion, is there anything unsaid that you want to make sure we get across tonight to everybody?
I've probably said way too much. I'm going to let May talk for a while. I apologize to her profusely. So,
what are you talking about?
You can ask Tony. Tony and I, if we've started our relationship just over the last 3 weeks, he'll ask me a 1-sentence question, and he'll get back like a 2-paragraph text, and then I'll think of something else, and I'll send him another 2 or 3 paragraph text. And then I'll send him another page of stuff. So he's probably tired of me blowing up his phone.
It's good. It takes the pressure on me to come up with an answer.
More information is always better than no answer, you know.
Were there any other questions? Because, we're almost at 2 hours, which is a great conversation, quite frankly, on bonds.
Yeah, I'd like to wrap it up at about 2 hours and if someone has a great question, we can take 1 or 2 more, but I want to respect these guys' time also. And I haven't eaten dinner yet.
What?
It's 7:30 here. It's Miller time here.
We're on about a 15-second delay, so I'm gonna start counting down 15 seconds.
I mean, I'm excited to see him do more of the Billie Eilish, and I still think there's a lot that they can do on the music side. A lot of people discount that, but like the music folks are like music artists have very clearly been really angry at the limited distribution / return that they get from that distribution. So I actually think that people are very much so not taking full notice of that.
Deadpool versus Wolverine is doing really good on the pre-sales, but so that is good. But I think in my wrap-up remarks about this debt, this whole thing, I would just like to say that I think the people that are complaining the most about it don't really understand, anything. Unfortunately, the process that the company has to go through, and the fact that they really don't have a lot of other options other than issuing equity. And so I want that to be very clear. Like, you guys probably should expect more dilution. It would not surprise me. Sparky, would it surprise you if there's more dilution?
The better they do, the less they'll be. It's just that simple.
The better the company does in terms of earnings and stuff, and
just generating cash, the better they do, the less.
But it should not be a surprise to anybody if there is more. I mean, there's definitely potential for more because they're trying to pay down that the debt that we had highlighted here in yellow.
Well, but it's also the cash burn. I think they're back up, and who knows what's going on right now, but they got back up over 800 million again, I think, at the end of third quarter. I think they'd like to stay there. If they can get through the summer without burning more than 100 million of that, maybe they don't.
That is key, guys. Go see some movies. Go buy some popcorn.
But Tony, that's it. If they get through the summer without significant cash burn, even if they don't make a penny, but they don't lose and don't burn a bunch of cash, then the dilution slows to a crawl.
I've said most of this year so far, the 3 things that I'm looking at are cash on the balance sheet, box office, so I can calculate income or loss, And then, that translates to cash burn. The bigger the box office is, the less the loss the company has, or if they can make a profit, even better. Yeah. And then you don't have cash burn, and then you minimize the need for additional dilution.
And if they get to that point, rolling over the debt is easy peasy, and they don't even have to do stock swaps against debt, because if they're marginally profitable, they'll find buyers for debt.
So everything works together. But I mean, the biggest problem the company had in the last couple of quarters was just, not enough movies and not enough good movies. And we're just about to change that. So cross fingers for Q3.
Wait, what is this message? Joe Rogan died. Is that true, or is that?
Someone always dies in every live stream, May.
Oh, sorry. I was like going to be so upset. Don't do that to me, guys. Okay, not when I'm a guest. Sorry.
All right. Any other wrap up thoughts? Otherwise, I want to thank both of y'all for your time, Sparky and May, as always.
Thanks for having us. Always a pleasure.
You're amazing. I'm sorry if I talk too much, because
no, you were passionate. I like it. You were positively passionate. That's great.
It's your first live stream, Sparky, and you had a lot of information to share with folks.
So welcome to social media, I guess. Welcome to social media for me. I
appreciate you taking the time and sharing your knowledge, because this is something I'm still trying to get, to even somewhere close to either one of y'all's levels.
It goes both ways. I learned a couple things from May and from you. Just
I learned a lot.
Go back and forth also. So
100%.
All right, guys, I'm going to run the outro, and if you want to hang around in the back room for a minute, we can chat after that's done. And if you just want to sign off and go pour your second drink, you can do that too.
I'm going to go get another drink while you're doing it.
That's a great idea.
Let's go. Yo, I'm like an addict, I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it, fuse like a magnet. Lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Rising the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last.